We are live on YouTube for the Tuesday edition of the Not Your Average Investor Show. Today, we're talking about AI. Does it give great real estate investing advice? ChatGPT versus chatting with PG and GC. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, moderating the chat, bringing the connection points together. So we call her MTM because she is Madison the Magnificent, and because she brings us the moments that matters. Say hello, Madison.
Hi, everybody.
And, if you're joining us here live on the interwebs, whether you are a robot or a human, the best way to enjoy the show is go to nyais.com, sign up on a Tuesday or Thursday. We do it live at 12:30 Eastern. Join us in the chat. This is going to be a heavily interactive show today. And you always get to interact at least once, because what do we do when we start the show, GC?
The roll call,
The
baby.
roll call, baby. We got Denny Davis with a hello, fellow average investors.
Hello,
Denny.
above average.
Above average investors.
Yes, we are not average.
Guten Tag, Denny. Good to have you, buddy. We got the MVP.
Lee Bishop.
Lee Bishop saying hello, everybody. We got the real estate maven from the mountains of Colorado.
Ms. Leslie Wilson.
Yes, Leslie Wilson. We got Chris Lee from Fernandina Beach back in the house. We got Nadeem Shah with his trademark good morning, good afternoon from the West Coast. We got our usual leadoff hitter,
John Henning.
John Henning, greeting us in the chat. We got Amy Matthews is back. Amy from our
Right, Amy.
IRL community. She was also there for karaoke. Just FYI.
She is. She is.
She was.
She was.
We got Big Papa in the house. We love when he calls in Big Papa.
What's up, Pops?
It's Jay Cohen,
Big Poppy in the house.
Greg's father. Different guy. Big Poppy is a different guy.
That is true.
It's a different guy.
He's coming along.
We got Joby One Kenobi, Joe Bussy in the house. Oh,
There we go, Joe.
I shouldn't have said it. I should have said
You
Joby One.
totally stole that one from me. I
Sorry.
wanted to knock that one out of the park.
I know you
like
know
Big
this
Poppy.
one. I know you know this one. We got the touchdown maker.
Shannon Baker. Oh, you'll love this. So we had this wonderful testimonial that one of our clients, Michael Santorios, sent in, and he started off the testimonial, and we read it in our Tuesday morning meeting.
Mhm.
And the first line was, "I wanted to express my sincere gratitude for Shannon Baker, who I have come to know is affectionately called the touchdown maker." It brought the house down
I
for the
love it.
Tuesday
I
morning
love it.
meeting.
I love it. From the Not Your Average Investor Show to the world.
It was wonderful.
All right, here we go. We got Rowan Schofield in the house from New Hampshire. Welcome back, Robin. Good
All
to have
right.
you. Layla Powell.
New name?
It's a new name.
New name?
New name.
Welcome to the
show.
party.
Welcome to the show, Layla. Good to have you. We got Big Ern Opperly in
Big
the house.
Ern, good to see you, buddy.
Big Ern. From me and Aaron. I guess he is representing Aaron O'Neill, who is
Into the
lights.
lights.
Good to have you, Aaron, as well. We got the Mountain Man.
Bill Green.
Billy Green from the slowly warming mountains of Colorado. I love how he's always giving us the update of the mountains
do
of
too.
Colorado over there. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Meline. We salute you. Big news. He found his iPhone. Ken.
All right. It's wonderful. It's good. It's a good day.
It's a good day. It's a good day out here. We got Not Your Average Guest. Hello on my phone sitting on the beach. If you checked in from your text, you show up as Not Your Average Guest. So we don't know exactly who your name is, but I'm happy you're having a beach day.
I love that.
Yeah, that's
Wonderful.
great. Enjoying the show from the beach.
There you go.
It's wonderful. Right along, Raj in the house.
All right. Right along, partner.
Raj Bantu, my buddy in the IRL meetup, right along. We got Aaron Wilson from Powder Springs, Georgia.
Is that a new name?
New name.
New name. All right. Welcome to the party.
Welcome to the show, Aaron. Good to have you in the house. We got another Not Your Average Guest saying hi, everybody. We got Gerald Schwartz in the house saying howdy. We got Marilyn Cotterman, Homosassa, Florida.
That's the home of the manatees, Pablo.
Home of the manatees. She said hi from the manatees in Homosassa. Tell the manatees we say hello, Marilyn.
There
I
you
don't think
go.
they've ever really checked in with us. We always talk about it. We got Mary Rockoff from Arizona in the house. Glad to be back as well. Glad to have you. We got the man that everybody knows.
Noah Randari.
Well, Randari greeting us from California. Good to have you back. Oh, it's Drew that's hanging out on the beach.
Oh,
Florida
perfect.
man, ringmaster of the Not Your Average Investor Show community.
Andrew Barnhill.
Drew Barnhill. It's Drew. And he writes, it's Drew on the beach, ringmaster.
Fantastic.
I love it. All right, let's get into the show. So, one of the things that I'm excited about this show is that this is going to be one part testing the computers versus Greg. One part, I've been messing around with ChatGPT a bunch, right? So if you haven't done it, I think that you're also going to get a little bit of insight into how to prompt ChatGPT in a way that's going to give you good answers. Because I've been doing this for a while, and right off the bat, the MVP is checking in saying AI is used in RealFlow or Delio Pro, and it predicts possible sellers or properties. It's sold by zip code. I have 10 zip codes, and it really works. Pretty
Very cool.
So here's what we would like. I've got a couple of things already prompted into here that we're going to test and see what GC says about it. But if you have questions for ChatGPT, put it in the Q&A and I will reframe it as a ChatGPT prompt and we'll do some of it live. Bless you, Madison. She just sneezed off camera. And yeah, we want this to be totally interactive, right? So Leslie Wilson already popping in. A topic suggestion for a future show would be protesting the property tax assessment in Florida. Colorado property values jumped up an average of 33% in this last year. This is 2-year cycle, so I am knee deep in my value protest. Great.
Cool.
We'll put it on the list.
Writing that down.
All right. So make sure. And Billy Green says, if anybody wants my custom written ChatGPT prompt to program it to answer all your questions in the character of Rodney Dangerfield, please let me know. I love that, Billy Green. I've used Jack Black. I've used Ryan Reynolds, but I have not used Rodney Dangerfield. I get no respect. All right, cool. Let's start with a foundational question that I asked ChatGPT. And that is, what investment classes offer a similar combination of rates of return and risk mitigation as investing in single-family workforce housing rental properties? GC, you want me to read this off or are you going to answer it first?
Yeah, let's go with ChatGPT because I've already seen it. So
You have already seen it. So ChatGPT says this: investing in single-family workforce housing, I'm not going to do the whole robot voice the whole time. Workforce housing rental properties offers a unique combination of rates of return and risk mitigation. However, there are other investment classes that can offer a similar balance between potential returns and risk management. 1, multifamily rental properties. 2, real estate investment trusts. 3, real estate crowdfunding. 4, commercial real estate. 5, high dividend stocks. And then it finishes with it is essential to remember that each investment class comes with its own set of risks and rewards. A well-diversified investment portfolio, including various asset classes, can help manage risk and optimize potential returns. Consult with a financial advisor, blah, 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 blah. GC, what do you think about that answer?
I think ChatGPT is in a pretty good spot there. I think they largely said what I would have said. I don't agree with the high dividend stocks thing just because, we just did a case study on this and we actually analyzed the performance of the S&P 500, which actually does give a dividend, which is kind of rare in the stock market. So we kind of analyzed how did the S&P 500, higher dividend stocks than what is normally available, how do they perform over the last 20 years versus single family rental properties in Jacksonville, Florida? And what we found is that single family rental properties actually produced more consistency from a cash flow perspective as it continued to grow. And overall, it outperformed the stock market by 44%. So I wouldn't say that high dividend stocks, I wouldn't have gone there. I wouldn't say that that's comparable, but you're thinking multifamily rental properties, commercial real estate, direct ownership of rental properties is where I would have gone, whether that is, multifamily, commercial, syndications. Those are what I would have come off of, the dome piece here.
So direct ownership of real estate properties. So the multifamily piece, the commercial, that's kind of comparable as well. What about REITs? It says that REITs is comparable. How do you compare kind of like the risk mitigation versus risk reward for this?
I mean, REITs feel like real estate, but they're not direct ownership of real estate. And there's a big difference there. I mean, like, for example, right now, REITs are getting crushed, right? REIT returns are down significantly, 10, 15%. But, single family rental properties prices are, either going up or they're flat in most parts of the country right now, even though you don't hear that from the media. When you look year over year, that's really what it is. Rents are continuing to rise. So direct ownership of single family rental properties, or if I'm even going beyond that, direct ownership of properties will put you in a place right now where your returns are consistent and improving. You're consistent and growing. Whereas if you're in REITs right now, it's still an emotional place. Yeah. I mean, that is really why at least a lot of these single family REITs and multifamily REITs are not performing well, even though the underlying asset is largely performing well. And then REITs also open yourself up to different asset classes, which share different risk profiles than single family rental properties. One of the asset classes that's getting crushed right now and probably is in for some tough times is commercial office.
True.
And a ton of REITs are made up of commercial office. So I really wouldn't go for a risk return profile. I wouldn't have said REITs and I wouldn't have said high performing dividend or a high dividend stocks. I would have gone to your direct ownership of multifamily, certain, commercial properties you certainly can own depending on which type of asset
Medical
class.
office, industrial
Sure.
stuff that's got a good tailwind behind it.
Yeah,
right?
exactly. And then even syndications or crowdfunding and things like that, if it's based in direct ownership of the asset, I think, you're largely getting to that 10, 12% IRR conversation with limited risk of volatility.
What I hear in your distinction, so I think the dividend stocks thing, I think we're used to beating up on.
Right.
Right. And you did the whole Karate Kid thing. The REITs thing, people tend to equate it. I think it's hitting one of these themes that we keep talking about, that right now, in a time of panic, uncertainty, in an interconnected world, liquidity has an elevated level of risk.
Right.
Right. So it's like this idea that the REIT, some of the things that people like about it is that it's liquid, but in this like unprecedented level of uncertainty, too much liquidity adds a little bit of risk to the equation that we hadn't really priced in generations before us, because all these different things that are coming together hadn't never really happened before.
Yeah. You were the first one to kind of bring this up. It's this
I
age.
was.
You're
Yeah.
such a pioneer. It's, this information that we have access to and how quickly it spreads now. You sprinkle on some liquidity onto that and you create an emotional place that things can change wildly. I've seen that time and time again over the last few years when you're thinking about meme stocks. Well, the same thing also plays in, call it REITs in this example, or other stocks, right? Other equity positions in the stock market. You read a news article, you start to hear about how some type of asset that's underlying in the REIT is not going to be doing well, whether that's true or not. And then all of a sudden, REITs get crushed when the underlying assets for a lot of these REITs, if you're not in commercial office right now, the underlying assets are performing well.
Yeah.
So.
Yeah. That makes sense, man. That makes sense. All right, let's move on to the next question. Still looking for the first good Q&A to prompt in here for ChatGPT.
It won't be long.
It won't be long. I'm sure the community is ready to contribute. Here's the next one. I wrote, computer, if I wanted to invest in rental properties passively in a market that I don't live in and I've never done it before, what steps should I take? Put it into ChatGPT, and here is what it responded. Investing in rental properties passively in a market that you don't live in can be a rewarding experience if done correctly. Here are some steps to guide you through the process. 1, set clear goals. Determine your investment objectives, such as cash flow, appreciation, or tax benefit, and establish your risk tolerance and time horizon. 2, research markets. 3, build a team. Assemble a reliable team of professionals, including a real estate agent, property manager, attorney, and accountant familiar with the local market. These experts can help guide you through the process and ensure you're making informed decisions. 4, choose a property type. 5, secure financing. 6, analyze properties. 7, due diligence. 8, make an offer and close a deal. 9, property management. 10, monitor and optimize. Remember, investing in out-of-state rental properties requires a strong understanding of a local market and a reliable team to support you through the process. Take your time, conduct your research, blah, 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 blah. GC, what do you think about that answer?
I think ChatGPT is close here with one big glaring mistake. And
I wonder what that is.
I'm not surprised, right? Most, call it average real estate investors, make this same mistake. And it's because you don't value the property management arm of investing in single family rental properties. I was really digging their answer here as they were going, in the first, 2, 3, 4, right? Number 1 was set clear goals. Huge fan of that.
Yeah.
Number 2, they said research markets. I would have gone team.
Yeah.
The team is what is going to make this an enjoyable experience for you so that you are in the game for a full market cycle so you can benefit from all 5 profit centers. So I would have gone strong with team. And they broke down team as like real estate agent, property manager, attorney, accountant, all that other stuff. And then later they separately said, oh, number 9 is property manager.
Yeah.
Well, that's not true. Your property manager is the most important teammate here. So I would have had one very big glaring correction for ChatGPT there, but largely they did pretty well. I mean, I didn't even know they were going to talk about a team. So I'll give ChatGPT some credit. I think your mode for doing this successfully is team, then market. If you take care of number 1 and number 2 well, the number 3 decision is choosing the assets. And that should be fun, enjoyable, relatively easy, and then you're off and running.
Love that, man. Yeah, I was when I got this answer, I was like pleasantly surprised
Yeah.
by the idea that it wasn't like, go look for a property first, then go whatever, secure financing, get your credit checked, right? Like
Sure.
it was a pretty good definition of the overall holistic thing with the glaring thing of like property management being well below after they had kind of nailed it with the whole team thing.
They even put property manager in the team thing, but then they went way out of their way to say it was the number 9. I don't know.
Yeah.
But
So
not surprised.
yeah, but pretty good, pretty good. So, overall, if you put that number 3, which they put build a team number 3 above research markets, right? Like find the markets where there is the team that you can count on, then you're in pretty good shape. Maybe it was just an order of operations of property management there, not as much as like valuing, but if the property manager is the team that you're vetting, it's a big deal. The other thing that I think obviously stands out to me is this idea of like build a team. Real estate agent, property manager, attorney, account familiar with the local market, right? Like that seems kind of daunting when there is the idea of like, is there a team that's vertically integrated?
Yeah.
Right? Like where can you, maybe it's like build a team and look for where you can find all those parts of a team, first or
How much would you have been fired up? I mean, your prompt said to do this passively. How much would you have been fired up if number 1, it said invest with a vertically integrated company? What would that have done for you? You'd have been so fired up.
I would have done a cartwheel.
You would have done
a coffee shop.
That's a little suggestion there for
Yeah.
ChatGPT. Do that one next
That'll
time.
go into computer train on this data. All right, cool, man. So far pretty good, right? Like so far we've had
Pleasantly surprised.
Pretty good suggestions. Doug Lowenthal, who is a computer genius in our community.
My buddy Doug. Good to see you, buddy.
Yeah, our buddy Doug, man. He's bringing up
my
good.
buddy.
He's your buddy first. Your buddy.
That's right.
First.
He's
All
my
right,
friend. No, he could be your friend.
Okay, cool. Doug, we're friends. So he puts also joined a few minutes late, but not sure if this was covered. In my opinion, it's important with ChatGPT to tell it who it is, the role, before asking it to answer the question to that person. For example, you're Robert Kiyosaki, a top tier real estate investor. Agreed, Doug. So one of the things that I wanted to point out is in these questions that we've asked, the more context you give ChatGPT, the better answer that you're going to give. And we are using the 4 model, which is why I kind of started simple with saying, if I wanted to invest in rental properties passively in a market that I don't live in, and I've never done it before, what steps should I take, right? Like notice that in the other question that I asked, I put, what investment classes offer similar combination of rates of return and risk mitigation as investing in single family workforce housing, right? Went a little bit wider there, but we're going to see as we do these prompts, you'll see the more and more specific the information that you get. So Aaron Wilson has a great one. I'm gonna start inputting this thing as Gregg is answering this next question so that we are able to like jam through it. Yeah, this is cool. I love this. This is what we're hoping would happen. Here's one where I put a ton of context in. I'm gonna share the screen right now so y'all see the amount of context that I put into this one. What zip codes in the United States have shown the highest returns for rental property investors over the last market cycle? Please only include zip codes that also provided positive monthly cash flow from day one, assuming purchase with a conventional mortgage with 25% down payment. Please list the zip codes and the cities they belong to, right? So here comes AI's limitation of only being trained up until 2021. As an AI language model, I cannot provide real-time or recent data, and my knowledge is limited to information available until September 2021. It's essential to conduct blah, 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 disclaimer. That being said, some zip codes that have historically performed well for rental property investors in the past include 38126 in Memphis, 46218 Indianapolis, Indiana, 48204 Detroit, Michigan, 4305 Toledo, Ohio, and 32209 POT dub regular.
There you go.
Jacksonville, Florida. Please note that this list is not exhaustive, blah, 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 disclaimer. GC, what do you think when you see that?
So it was nice that we made the list there.
I was nervous about that.
Nice to see that. Here's my thought on it. When you look at the last 20 years, if you invested money in rental properties in Memphis, Indianapolis, Detroit, Toledo, or Jacksonville, there's no way that if you invested in Jacksonville versus investing in Toledo, Detroit, Indianapolis, Memphis, there's no way that Jacksonville's number 5 on that list, right? Jacksonville investors over the last 20 years have definitely earned more than Memphis, Indianapolis, Detroit, Toledo. How do I know that? Because I know what the average home price appreciation rates are in these other places. I know what Memphis is. I know what Indianapolis is. It's not Jacksonville. And when you think about investing hundreds of thousands of dollars, right? Some of our clients have 5, 10, 15, 20 properties with us in a certain market, and you go out 20 years and you get just 1% more of home price appreciation, that equates literally to millions of dollars of additional return on investment. So I happen to know those markets well. I know that their home price appreciation levels over a full market cycle are significantly less than what Jacksonville is. So while I'm happy, I do think from a cash flow perspective, they chose some strong markets there. Memphis, Indy, Detroit, Toledo, somewhere around there in Ohio. Those are strong cash flow plays, but those are not the best risk-adjusted return plays. Jacksonville also is a strong cash flow play like we're talking about, but we have better than average home price appreciation. So again, I feel like ChatGPT was doing better than I expected here, but it's missing a key element, which, it's probably pretty common for a lot of answers when it comes to AI generated things right now.
Yeah. And I think it bears to say that this thing is trained on the information out in the internet, right? So like this is average investing advice being put in with a smatter of not average, right? Like by definition, not your average advice is the minority of advice, right?
Sure.
So I think it's doing pretty well. And to answer the questions of whether this is 3.5 or 4, this is ChatGPT 4. I pay for the premium subscription. You're welcome. I'm donating it to the show today.
Love that.
And again, pretty close, pretty good, not exactly accurate and contextual to the thing that you actually want, but it just gave us a perfect premise for a show.
Yeah.
Right.
Love it.
Like, let's do a case study between these 5 zip codes that ChatGPT told us.
Love it.
Over the last 10 to 15 years.
Writing that down.
Let's go, big boy.
All right.
So,
case study. You want to do a case study for what? For these specific
for
ones?
these exact zip codes, like over the last full market cycle, right? Like, let's call it, you bought it in 2010 to today. What are the best returns?
Okay.
So that's another lesson here to learn off ChatGPT is it may not give you the perfect advice, but it's a heck of an idea generator.
Oh, it's amazing, right? If people who are entering our client onboarding process were like, hey, listen, I've got an idea of what the best performing markets would have been for passive income rental properties. Here's what I'm thinking.
Yeah.
Is this right? Like, wow, that is a super educated, like amazing conversation we get to have.
Yeah.
Right. And that's the value of ChatGPT.
It's a super big value for me personally. Like the ability to go from idea to first draft of like answer is a huge one, right? Like it just takes a lot of time out of the process of how I would begin to answer. I can like look at it and then adapt it to whatever. Spoiler alert: a lot of our show premises these days are first draft done by ChatGPT. So you know what? Maybe we go into my ChatGPT and show how we generate these responses.
It's been a game changer for us.
It's been awesome. It's been awesome. All right, Aaron Wilson, you get the kudos for the award for first person to give us one. All right, Aaron, thank you for doing it. Aaron asked to answer the question from the show description, and I literally just typed it in as GC was. I
don't want to see this one. I don't want to see it. I just want to answer before.
Then close your eyes, because I need to read it, bro.
All right.
I put, if we have 200K. Oh, actually, you're right. Why don't you answer it first?
Yeah.
If we have 200K this is what I put in. If we have 200K to invest into rental income properties, what is the benefit of financing 3 of them over buying 1 in cash and having a higher cash flow?
All right. So the first benefit that you'll have from financing 3 rental properties versus buying 1 is a higher return on investment. When you are using other people's money, when you're using financing, you're able to use that leverage and you're able to earn a higher return on investment. So that's typically the best reason, or the number one reason people go to financing. In addition, something that is also really critical is diversification within your real estate portfolio. The reality is that for every rental property, at some point, that resident is going to move out. And no matter how great your property manager is, when your resident moves out, that's the most painful time for you as a property owner. That's when you get hit with maintenance costs to put the house back into great rental shape. You have additional mortgage payments to make where you don't have rental income coming in. And you also have a new tenant placement fee to pay. So that's not fun as an investor. The diversification really helps from your client experience, because What I tell folks is when you have 3 rental properties, you typically always have some little issue that's going on with one of them. Sometimes it's a big issue, but you always have something that's going on with one of them. And when you have some issue, you are underperforming for that rental property at that moment. But the other 2 are generally performing really well. And you are overperforming for those other 2 when they're rented and all that other good stuff is happening, no maintenance, things like that. So the overperforming of 2 balances out the underperforming of 1, and you're steady. And that's really key for you to stay in this asset class and enjoy it for a full market cycle so you can benefit from all of them.
Those are the upside to doing it. What's the downside? Because I'm looking and ChatGPT gave us like a upside and downside to it. What's the downside to getting 3 instead of 1?
You have less cash flow coming in. If you buy 1 property and you have all of that cash flow coming in because you don't have a mortgage, you'll have more cash flow coming to you on a monthly basis.
Okay. All right, ChatGPT. Let's see what ChatGPT says. Here we go. So you see the prompt here, right? Aaron, for the record, Aaron put in, if we have 200K to invest, I just put a little bit of clarification around the context, right? And here's the answer from the computer. Investing 200K into rental income properties presents 2 options: financing multiple properties or purchasing 1 property. Both approaches have their advantages and potential drawbacks. Here are the benefits of financing 3 properties. 1, diversification. By financing 3 properties, you spread your investment across multiple assets, reducing risk associated with relying on a single property's performance. You hit on that.
Nailed it.
2, leverage. Financing allows you to leverage your capital and potentially acquire properties with higher combined value that if you used your cash to purchase a single property. Leverage can amplify your returns of property. These kind of all bleed into each other, right? You talked about leverage, but you talked about it for potential of higher returns, right? With free finance properties, you may be able to generate a higher overall return on investment than with 1 cash flow purchase. 4, opportunity for growth, kind of the same for potential returns. 5, tax advantages. You didn't really hit on that.
How did I not hit on tax advantages?
I don't know.
God,
Mr.
good.
Tax guy. Tax advantages, mortgage interest. Mortgage interest is tax deductible, which can help offset your rental income and potentially lower your tax liability. So those are the 5. I would call those 3. Right, because leverage, potential for growth, and opportunity, potential for higher returns, opportunity for growth are 1, and then tax advantages. But definitely hit at the core of what you said of the upside, the diversification of the downside of the moment, right? Like the cash flow paying for itself on the other one versus 1, the leverage piece, and then of course your favorite tax advantages, which you didn't say.
I will say tax advantages. They said tax advantages, so I'll give them credit for that, but they're not talking about the right tax advantage when they're given the reason behind it.
Oh, tell me more.
Well, they're talking about mortgage interest, which is tax deductible, but the real opportunity here is when you buy properties with financing, you get a bigger impact from depreciation from a tax perspective. The depreciation goes farther. It helps create more tax savings for you. So that's the real answer on the tax advantage. So we kind of tag teamed that answer, me and ChatGPT.
I don't know. I don't like this new partnership for me. All right. However, it's essential to weigh the benefits against the potential drawbacks of financing multiple properties. 1, debt and risk. Financing properties means taking on debt, which increases your risk exposure. In a downturn, or if rental income doesn't cover expenses, you may struggle to meet mortgage payments. 2, lower cash flow. Monthly mortgage payments will reduce your cash flow compared to mortgage-free properties. This is what you said. And 3, management complexity. Owning multiple properties requires more time and effort to manage, and you may need to hire a property management company to handle the day-to-day operations. What do you say about those 3 downsides? You hit on lower cash flow. What do you think?
Yeah, it just depends on the lens, right? So my lens was coming from you're buying cash flow properties that pay for themselves. So that was my lens. Not everybody does that. So I think that's really valuable for ChatGPT to say that debt and risk. And if you don't have enough rental income coming in, you may struggle to meet mortgage payments. Make sure you invest in cash flow positive properties. And then the management complexity, I'm coming from the lens of you're investing with a vertically integrated company, and I think ChatGPT highlighted a very big, important complexity out there that needs to be talked about if you are not going with a vertically integrated company.
Or if you are, correct. Whatever property, whether you're doing it yourself or you're picking a property manager, you need to keep in mind how capable is this property manager, right? Like kind of the things that we talked about in the past of like, is this a professional property management company or is this Uncle Sal?
Right.
And like, do they have enough employees where they are, dedicated, specification of labor, right? So like one person is driving one outcome versus like trying to manage 10 properties and leasing them and also maintenance and all these different things.
Right.
As opposed to somebody that's in charge of leasing, somebody that's in charge of maintenance, somebody that's in charge of like ROI, stuff like that, right?
Love it.
Cool. So this is another one, right? Kind of, these are all B's, B minuses,
Yeah.
C pluses, right?
Mhm.
Pretty good.
Yeah.
Pretty good. Pretty good. All right. Raj has got something here that isn't for ChatGPT, but since Raj is a valuable member of the community, shows up, I'm going to ask you the question.
Mhm.
Asks, small, medium, and regional banks are under pressure. Does JWB see any impact on their new construction financing because of bank deposit issues?
Great question. The answer is no. The vast majority of our financing for our new construction projects comes from you all, our private lenders, our clients, right? We borrowed over $300 million of private lending funds, and we continue to use those funds over and over, meaning we build a house, right? We sell the house, we return the money to you as the private lender, and then you give it right back to us on that next house that we build. So that's the foundation of our financing for our new construction properties. So we are, adjacent to all of the mess with small and regional banks, and it's not having any impact on our build times and our build volume.
All right, then. All right, GC, we have, this one was actually little story behind the story here. As I was put on my agenda to think of what questions to prompt ChatGPT, I also decided to go work at a coffee shop yesterday. I sat down and I happened to run into 3 people that are here in real estate locally. So I outsourced the questions, right? This one is actually coming from Kurt Stein, our good buddy from Spikeball. And his question was, what are the bottlenecks to scaling a rental property portfolio? What would be your answer to that, GC?
The bottlenecks to scaling a rental property portfolio, the bottlenecks would be management for sure. Not having a vertically integrated team really hampers your ability to scale. I would say your financing for many, I'm trying to take it out of the lens of JWB now. I'm trying to go a little bit bigger picture. I would think financing is a real challenge for folks to understand how they can build a rental property portfolio of 5 properties or 10 properties. Yeah, that's probably where I guess if I'm thinking outside of JWB and vertically integrated, right? Access to inventory, especially at a time like today where inventory is extremely low. You were talking about, you got 2 months of inventory out there right now.
Yeah.
Which if you want to find out more about what that really means, we've got the quarterly call coming up next Tuesday. I'll do a little bit of a deep dive there. So yeah, I would probably go there.
Okay, well, let's test your answer with what the computer says. Computer says, scaling a rental property portfolio presents several challenges or bottlenecks that investors need to overcome to achieve sustainable growth. Some of the bottlenecks include financing, you mentioned that, property management, right? Like growing a number of properties can be time consuming and complex. So you got to find the right property manager or have it yourself. Market knowledge. As your portfolio grows, you may want to diversify into new markets. However, acquiring in-depth market of multiple markets and identifying profitable investments opportunities can be challenging across many different markets. Deal sourcing, right? Inventory, what you talked about, legal and tax implications, maintaining cash reserves, and time and resource management. So time and resource and property management seem to be the same thing. Market knowledge and legal and tax implications feel like similar. No?
Nah,
all right. Tell me
what
do you think about this answer?
Well, I think it's great. I think they did a great job. I think they did better than I did. Market knowledge really goes to that expert, right? There's no national real estate market. And for you to invest in direct ownership of rental properties, either you or the team that you're working with needs to be that market expert who has that market knowledge. So if you don't have that, that's going to hamper your ability to scale. And so I really like that one. Deal sourcing, inventory, we sort of talked about. Legal and tax implications, I don't know. That doesn't really strike me as one, to be quite honest. I mean, I don't know. Cash reserves, I really like that one though.
True.
We get that question all the time on the show. If I'm thinking about buying a rental property, how much reserves do I need for a rainy day? And those answers, while so important, those answers are so simple too, right? It comes down to time, proven, tested ways of making sure that you have funding for a rainy day. And you mix what we, tend to know in the financial world of, call it 3 to 6 months of expenses is generally accepted for what you want for a rainy day. And you work with a provider who has specific details, who knows their data so well that they're able to project what maintenance costs will be. And then that does not have to be something that, limits your scalability. You can walk in with confidence there, but most people don't have that. So I really like maintaining those cash reserves.
It's funny, man, because as I'm reading these things, I think about what your business model is.
Right.
Your business model is, how do I make it easy for someone to scale a rental property portfolio?
Right.
Like that is the problem that you solve. That is why vertical integration is the answer.
Right.
Right. And everything that you do is geared by how do we solve this problem, less so than like, what do I want to do as an investor? Right.
Mm-hmm.
Like you have created the data flywheel because of that. You've created interfaces in order to like create visibility. You've scaled a property management company that can handle 5,000 properties, and you've built your operation that way. And I see it as kind of like these answers of outside of financing, because your answer to this is develop a network of lenders that can get this deal through, right? And then beyond that, it's been build a property management company, stay in one market so that you guarantee having top-notch market knowledge.
Sure.
Your deal sourcing, you've piled up a whole bunch of like lots that you can build on and developed infill building of build to rent rental income properties.
We have over 1,000 lots that we haven't even started building on.
Lots of lots.
Yeah, lots of lots.
Lots of lots. You have a team that manages the legal and tax implication that McKillop company that,
Right.
that you partner with, giving advice on tax reserves, and then time and resource management, right? Like you created all of this in order to like minimize the time and resource management for the investor. Kind of validating.
Yeah, it's a lot. It's a lot. And that's what it takes to make this thing easy for you.
Yeah. All right. So as you were there, you said that you had a typical question that you get all the time, which is, I'm thinking about investing in a rental income property. Here we go.
Oh, what do you know?
I just typed it in right now.
Cool.
I'm thinking about investing in a rental income property. How much should I keep in reserves to protect myself from a rainy day?
Very cool.
Right. ChatGPT cranked this thing out. It said, having a reserve fund for unexpected expenses for emergencies is essential for rental property investors. Although the exact amount needed for reserves can vary depending on individual circumstances, property types, and market conditions, here are some general guidelines to help you determine the appropriate amount. 1, 3 to 6 months worth of expenses. Similar to what ChatGPT said. Property age and condition, right? You kind of eliminate that risk off the table. Local market conditions. Oh, I'll let you answer. Kind of like your responsibility.
Well, the property age and condition, I would have said that's slightly different than you. We don't eliminate the risk.
Yeah.
We know what this property is going to perform on when it comes to maintenance cost and vacancy cost, understanding the property and age and condition that we have, right? Older properties have slightly more maintenance costs than newer properties. So it's not about eliminating that risk.
Yeah.
It's about understanding what the data has shown over multiple market cycles and then using that data to set expectations appropriately.
I would also add that you have created a standard of what does not defer maintenance inside of a rental property. And therefore, when you offer it, you know that the roof, the mechanicals, the shell, what else am I missing in there?
HVAC.
So major mechanicals, plumbing, electric, HVAC, and roof are all at a certain standard.
Mm-hmm.
And you build with durable materials that are easy to maintain and easy to replace in order to minimize for like ongoing maintenance as well.
Mm-hmm.
Right. So local market conditions, right? Like that is, how do you answer that?
So we're talking about building for reserves.
Protect myself from a rainy
local
day
market
reserves.
condition. Wouldn't have said that. Let's see what ChatGPT says. Economic conditions and local rental market trends can impact your rental income. Okay, if you're investing in an area with high vacancy rates or economic instability, consider maintaining a larger reserve fund to protect against potential fluctuations in rental demand. Yeah, I like that. I'm on board with that.
I mean, when I read that, I think of you talking about the importance of investing in an economy that has at least 1 million inhabitants for stability and to have a high net in migration, right? Like a growing market in order to like minimize for vacancy and like make sure that there's always demand for rentals in there.
I think that's all very good. And I would have taken the slightly different angle as well. Like that's
as is tradition.
That's as important as what I'm going to say, right? I would have talked about why we focus on workforce housing, right? Why do we focus on one segment of the housing market that reduces risk, that does not have huge economic swings in workforce housing? It's not based on, stock gains, right? When the stock market has a rally, it's not like it's affecting the base of folks that we're renting to. And on the other side, right, when there are challenges in the stock market, it doesn't take away, right? Capital doesn't seize up there that would ultimately, affect home prices like it does at the higher end. There's a correlation between stock market performance and home prices at the higher end. not workforce housing. So yeah, I would have said that's why we focus there. It's because it is steady Eddie. It is kind of adjacent to a lot of these, market conditions that may otherwise affect rentability and home prices.
There you go. Okay. I like that. That was slightly different, but is definitely the idea of the asset within the asset within the asset has multiple layers of risk mitigation. And that then affects, I guess the main lesson is the amount of reserves you need are directly correlated to how mitigated the risk is.
Yes.
I guess I never
100%.
thought of it that way.
Yeah. If you are going to multiple different segments of the housing market in multiple different cities in the country and all of those things, you probably want more than 3 to 6 months of reserves because there's a whole lot of variables. If you just stick to one market, one segment, workforce housing, which is a risk mitigated segment, 3 to 6 months is a great spot for you to be in.
There you go. All right, JC, good stuff, man. All right, I got another one here that was submitted by Steve Shane when I was having coffee with him. And I put in, if I was a rental property investor in the United States and was looking to maximize the returns I get from home price appreciation over the next 10 years, what type of neighborhood should I invest in? So here's what the computer says. As a rental property investor in the United States, to maximize returns for home price appreciation over the next 10 years, consider investing in neighborhoods with the following characteristics. 1, growth potential. 2, emerging neighborhoods. 3, desirable location. 4, strong rental demand. 5, low crime rates. Remember that real estate markets are local and can vary significantly, blah, 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 disclaimer from a robot. What do you think about this, GC?
Well, I think the way that you prompted ChatGPT, it gave you a great answer. But I think in the prompt to match with the way that I think, I would have included one simple phrase. If I was a rental property investor in the United States and was looking to maximize my risk adjusted returns, for the next 10 years, what type of neighborhood should I invest in?
Interesting. Why do you say that? Why do you say that that's different based on this answer?
Well, so when you are just going to maximum returns, you are trying to find that market that is like a shooting star, right? That market that's going to have significant population growth. And you might hit that market. You might choose higher value, higher priced properties in a higher cost market that is all driven by tech or whatever 2 years ago, right? And you might hit that. You might have the best returns over the next 10 years, but you're probably not producing cash flow, right? You're probably not focusing on a segment of the population that is underserved, that doesn't have enough housing, like workforce housing, which creates price stability and increases when you focus on a population. So it's like you're going to the blackjack table and you're going to, I don't know, what gambling reference do you use more often? I don't know. I'm not
like the $500 blackjack.
$500 blackjack game, right? You feel like whatever. You feel like you got a good stock tip on a market and you don't care about the risk mitigation. You might really hit the returns on investment because you chose a certain market that just appreciated a ton. But what did you have to do to get there to 10 years, right? Were you going cash flow negative on your portfolio of 10 or 20 rental properties to get there? That's not the way that I think. I think that the returns are good enough that I can focus on risk mitigation first, and I'm still going to outperform stocks and bonds. So when you're going for best returns, you're going to get answers like growth, emerging neighborhoods, path of progress, desirable location, low crime, right? Those are things that are kind of, more, if you focus on that only, then you might have higher returns. But
yeah, as I read this thing, growth potential is something we talk about, right? Like low crime rates in certain types of crimes is stuff that we talk about, right? So like no violent crime.
Sure.
Strong rental demand is for sure something you hit on. This idea of emerging neighborhoods, I think that's subjective, right? Like what's an emerging neighborhood? And desirable location, I feel like it flies in the face of the advice that you normally give. This idea that like, usually the place that you want to live is not the exact place where you want to invest in, because in these like middle to higher income neighborhoods, the rental demand is more elastic, right? Like they are taking disposable income and choosing to spend it on rental as opposed to just like making sure that their shelter is covered for. And therefore, if something happens to their job or the market hits, they're going to go rent somewhere that's like a lower cost place.
Yes. It's not that I don't love emerging neighborhoods. It's not that I don't love this term called path of progress, where we're trying to find the next big thing. It's not that I don't love Whole Foods and, owning rental properties around big shopping centers. It's not that I don't love low and almost non-existent crime. I love all of those things, but I realize that all of those things come with a cost. And that cost is me going cash flow negative. That cost means that to buy those types of properties, I'm going to have to pay a much higher amount than the median home sales price in that area. So in Jacksonville, right? I could bring all of you guys out to Jacksonville Beach or to Atlantic Beach or to Neptune Beach, and we could have you all invest in properties that are right next to Whole Foods and right next to some great shopping centers and and there's very little crime and all of this stuff. But at the end of the day, there's no way that the rental income supports the home prices in that area. So you all will be investing in cash flow negative investments. And that is risky. That is riskier, right? So this idea that you can have everything in an investment is just not real in my experience. There are trade-offs. There's pros and cons. And the trade-off that I make is that I don't need to be by a Whole Foods. I don't need to be in the highest rated schools. The more important thing for me is to make sure that this is cash flow positive. It pays for itself every single month. And then I choose segments of the population, segments of neighborhoods, workforce housing neighborhoods, where it's pretty good for a lot of those things. It's not perfect. You can definitely find better examples, but it's not low income. It's not the places where it is violent crime. It's not the places where there is significantly higher maintenance and vacancy costs. So there's just trade-offs. And I don't think people think a lot about the trade-offs. They go with their eyes emotionally. Oh, this just feels right because I could envision myself living next to a Whole Foods, but it's not risk mitigated. And so that's how I view it.
I mean, I obviously agree. And I also went ahead and put in your little caveat over here.
All right, cool.
Into ChatGPT as you were answering, right? So I changed the prompt to, if I was a rental property investor in the United States and was looking to maximize the returns I get from home price appreciation while mitigating risk as best I can over the next 10 years, what type of neighborhood should I invest in? And now the computer says economic growth, population growth, infrastructure and amenities, up and coming areas, affordability, low vacancy rates, diversification, safety, and crime rates. What do you think about that?
Well, so the way that you prompted it, because the prompt is really important, you prompted it first, I wanted high growth. And then secondarily, you said mitigating risk. So when I'm looking at your first, two answers, that's about high growth, right? High home price appreciation. So you're still focusing on economic growth and population growth. Those are your big wins. Now they're starting to, in numbers 3 through really 7, 8, they're focusing on risk mitigation. So infrastructure and amenities, access to transportation and things of that nature is attractive to renters and home buyers, but we're specifically talking about cash flow. So renters, so that makes sense. Low vacancy rates, affordability, those types of things. So I think it's matching the prompt. I think it's a pretty good answer. When you're looking for growth, you're going to be looking for things like emerging neighborhoods and path of progress and all of these what ifs that are subjective and may or may not work. When you're looking to mitigate risk, focus on things that are going to reduce maintenance costs, reduce vacancies, making sure you're working with affordable segments of the population and housing markets. That's how you do it.
Pretty good, man. Pretty good stuff. It's interesting how it changes, right? Like the incentives change the behavior, something we talk a lot about here on the show, right?
Absolutely.
It even happens to computers. All right. MVP Lee decided to think outside the box and ask it a doozy. And we asked ChatGPT just now while we were talking, can you predict when the Fed will raise interest rates in the US? So I can, what do you think it's going to say?
I mean, they just raised it another quarter point. I think that was the 9th consecutive raise. I think they'll raise it. I think they'll raise it again one more time. So I think they'll raise it again the next meeting, which I think is every 2 months. So I think I'm expecting more raises.
Okay, well, ChatGPT says that. ChatGPT says, as an AI language model, I cannot predict future events or decisions, such as when the Fed will raise interest rates. And then it says, predicting the actions of the Fed is challenging, even for experienced economists and financial analysts, as it depends on various economic indicators and the Fed's assessment of the current and future economic outlook to stay informed, blah, 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 blah.
Take a stand, ChatGPT. Take a stand, man. If you don't stand for something, you'll fall for anything.
I love it, man. I also went ahead and thought outside the box and I asked ChatGPT, What member of the NYAIS community is celebrating their birthday today? GC, what do you think it said?
Oh, goodness. Who's celebrating their birthday today?
Well, first of
I
all,
feel terrible because I don't
look
know.
at you. You just tied with ChatGPT.
Oh, no.
It says blah, blah, blah. I don't know. Just like ChatGPT. Leslie Wilson is
Leslie Wilson. Happy birthday.
Happy birthday, Leslie, the real estate maven of the mountains of Colorado. We wish you a happy birthday, Leslie. Love having you as part of the community. And to put a bow on this thing, right? We're going to ask something that we think about a lot here on the Not Your Average Investor show. And I asked it, and actually this was also Kurt's idea, which I thought was pretty brilliant. What are the key differences that separate an average real estate investor from an above average real estate investor?
Very cool.
Yeah, Kurt thought of that one. I thought that was great. And it puts an above average real estate investor often possesses several key traits and habit that set them apart from the average investor. Here are some of the key differences: research and due diligence, long-term perspective, strong network,
Love that.
adaptability and flexibility, disciplined financial management, risk management, continuous learning, and emotional intelligence.
I think ChatGPT nailed it.
Nailed it, right?
Nailed it. That was awesome. What a great question, too.
Yeah, that's pretty good, man. I think about kind of like how we just put together this class,
Mhm.
right?
Mhm.
And what you were, and you're like, man, I think the most important thing is at the end of this class is to tell people to just like start building their network, right?
Mhm.
Like join our community, get on the call with JWB so that you start talking to a real estate expert that can actually help you,
Right.
whether or not it's time to invest or not, right? Like going to chatwithjwb.com. If you are interested in this asset class, it's a good idea to
Right.
just start like, hey, start probing, like what the experience is like, what people, need to build, somebody that knows their stuff, somebody that has a long-term perspective, that has the research and due diligence in-house, that can introduce you to a network, right? Like those three things are already kind of like at chatwithjwb.com, right?
They are. And I go back to when I started in 2006, and it was really hard to get access to experts, access to information. I mean, this was before webinars. This was before, Facebook groups. This was before Zoom, and I had to go to real estate investor clubs, and it was once a month. And that was my opportunity to network and learn from those. And when I would go there, it was kind of like the good old boys and girls club. And everybody was like, oh, I know how to do this. I'm not going to teach this young whippersnapper. That was the feel. Now, if you are not connected, it's really on you. Right? You have such an opportunity. And those who are here in the community each and every week, it's just incredible what you all are doing. We're hearing this success that we share in the group here. We've got 50 plus folks that are here right now. And it's not a surprise. One of the things that I'm glad this is reminding me, this is something I wanted to do. I wanted to look at just our Not Your Average Investor Show community members and see their returns on investment and see how many properties they've acquired.
That'd be
right?
awesome. Yeah.
Like our group,
how much wealth has been created
just by this group
with our group.
Yeah, I'm going to do that. I'm going to do that. Cause our group, like we love our group. We're not huge, right? Like it's the right amount, right? We don't want to be this huge behemoth, right? We're small, but we're mighty when it comes to asset and wealth creation. Like we're mighty. And I think it's pretty special.
Love it, man. And as you say that, I think my favorite thing that ChatGPT said that I did not think it was going to come is emotional intelligence.
Yeah, true.
Right? Like I think this idea that us as a Not Your Average Investor Show community have built this like network. We are this place of continuous learning, right? We are bringing the research and the due diligence and shining a light on it, right? Like I think it's great. And I also think that this idea that we needed a certain level of emotional intelligence to have the self-awareness, right? Like for you to take a shot on this idea has, crazy guy Pablo that I met playing volleyball is telling me that I should start an internet talk show and build a community off of
That
it,
was
right?
pretty
Like
special.
it takes a certain level of emotional intelligence to understand that this is the the way to fill that gap, to solve that problem that you are motivated by of how do we help people scale their real estate portfolios without a headache. I think that's pretty cool, man.
You know, man, where you go, I'll follow, brother. You've led us this far, so we'll keep following you.
I love it, man. I love it. Also, limitations by ChatGPT and ChatGC is not knowing that it's Bill Shields' Feliz Cumpleaños tomorrow.
Oh, nice. That's awesome.
Yeah. So Bill Shields.
Feliz cumpleaños.
Feliz Cumpleaños, Bill Shields.
Did you know that there was a resident that was walking up earlier today? You'll love this because you know my Spanish speaking journey.
Oh, please.
They were walking up and they looked a little bit lost, and I went up and I spoke to them in Spanish and helped guide them. Do you know that? Bill Shields, are you proud of me?
I did not know that. And I feel like we referenced this a little bit on the show, but Gregg is going real hard at learning Spanish, y'all.
Taking classes twice a week for the last year plus.
Classes. He's got his own profesora, taking classes with her.
I'm still super scared. If you guys try to make me talk in Spanish on here, though, I'm super scared.
He has a goal of hosting a Not Your Average Investor show all in Espanol one day.
We're going to get there. We're going to get there.
We're on the way.
We're going to get there.
It's a really cool goal, man. I don't think there's a lot of people late in life that decide to learn a language.
Yeah,
And
it's tough. It's tough.
Continuous learning, continuous growth, all the stuff, man.
Love it, dude.
Emotional intelligence, so you can talk to your mother-in-law.
True. It's
Your
true.
grandmother-in-law.
All for the family and for the folks who happen to walk up and don't know where they're going and speak Spanish.
Sí,
like JWB.
muy bien, Gregg. Estoy muy orgulloso de ti.
Gracias. You're very proud of me. See, I got that.
There you go. This is an awesome show, man. I was super pumped for like what this could lead. I think we can do this every once in a while, right?
Sure.
Like bring the questions to ChatGPT. I hope that you at home learn something on, kind of like the limitations of it, how to use it a little bit, right? Doug gave some great advice to begin with. Give it context. You saw that the more context we give it, the better the answer, right? Like the prompt indicates the response as well. And now you can start learning to use this tool at home. And you've also learned that ChatGC is just slightly better.
ChatGPT, was it again? PGP?
PGGC?
PGGC.
Anyways,
Trademark that.
Never take for granted the fact that you showed up here, spent an hour out of your work, that we had 50 plus people here on the middle of a Tuesday. Aaron Wilson, shout out to you for being the first one to provide a question. We can do this thing all day. I love it. Thank you so much for being a part of it. GC, I'll give you the last words.
Happy birthday, Leslie Wilson. Happy birthday to Feliz Cumpleaños a ti, Bill Shields, de mañana. And thank you guys for making this so fun. We'll see you on Thursday.
Bill Green says that when he asks Leah questions, it's chat MVP.
Oh, love that. Love that.
I love it,
man.
On Thursday, we have a unique story. We got a guest investor. Tease it a little bit, GC.
So we have been bringing stories to you all of clients that invest in turnkey rental properties with us, actually buying the properties from us, and then we do the management for them. But there's a whole segment of JWB's clientele that actually does not buy the properties from us, that just has us as their property management arm. And so we've got this great story of a client who lives in California, super successful, full-time job, full-time real estate investor as well as his wife, real estate professional. And they buy properties in Jacksonville, Florida because they love the market so much. And guess who they use for their property management? You know it. So we're going to get inside their head a little bit about why they live in California, why are they investing in Jacksonville, and then how are they able to leverage a team like JWB to be able to maximize their 5 profit centers.
All right. Well, we hope to see you all on Thursday. And just remember, like whatever you use, whether you use ChatGPT, you use Chat PGGC, you use Chat MVP and get on the phone with Lee Bishop, whatever you do, just don't be average.